So, I'm not going to wait around too long. Looks like we got two people in here, so I'll go ahead and get things kicked off and started. Um, Winfried, I'm going to go ahead and tackle your question first from in the Telegram chat. So, I hope you're here for this, but we're going to get started right away with that. Sorry if my voice sounds a little bit off. I've had a little bit of a sore throat this morning. So trying to talk a little bit quieter and a little bit less. But just so everybody knows the background, we're going to be going over kind of Keynesian economic theory. I guess I didn't pull up any notes on that, but I can dive into it really quickly. Modern monetary theory, quantitative easing, infinity, and then a little bit about like how, why, and what levers that the Federal Reserve has access to, and what they do to uphold their mission, which for anybody that doesn't know what the Federal Reserve's mission is, their goal is to maintain as close to full employment as possible, and to keep inflation steady at around a 2% per year rate. So that's what we're going to dive into. But first, I'm going to do just quickly a look at the overall market, kind of what could have led to, in Winfried's term, this bear market, quote unquote. I don't necessarily think that we're in a quote unquote bear market. It feels a lot more like consolidation, even if it's a bearish cycle or a bearish trend or something like that. I don't necessarily think that we are in a full-blown quote unquote bear market. I think there's just too much money floating around for that. But Winfried, I guess to get to the root of what your question's actually asking, it's why are we in the place that we are right now, and potentially what could change the dynamics of the macro market and move us back into a market that is trending, positively, trending to the upside. And so the first graph chart that I've pulled up here for you guys is a look at the ratio of all job openings to hires in the private sector jobs right now. And so what you can see is that, in these big periods of time where there's liquidity crises, right? Or like the 2008 collapse, the 2020 collapse, etc. People look for jobs. They look really, really hard to find work because they know that they need to work to bring in income to put food on the table. And so during big recessions, people oftentimes notice that there are periods of tightening labor markets because everybody's trying to get a job, and that gives power to employers, the people who are giving away the jobs or hiring people or trying to bring in labor to produce their goods so that the investors, the owners, get to capture the upside from that value. So something that is different this time, is we can see that job openings, the ratio of job openings to hires right now is at an all-time high, at least in the past 2 decades. And so what this is showing is that there are an absurd amount of job openings in the market right now. There are plenty of jobs available and no people that are wanting to do those jobs. JHS John, our CSO, actually, made a comment in one of the admin chats yesterday that was kind of interesting. When everybody's rich, nobody's rich is kind of the thing that we're running into a little bit right now. So everybody has what they feel like is a lot of money, and so nobody wants to work. And I've said this a couple of times in these Telegram chats, and it's a little dark. It's not too fun to think about. But in my opinion, markets will slowly stop consolidating and start trending in a positive direction, in a bullish direction, when all these people that have become successful, quote unquote, day traders, altcoin flippers, callers, influencers, etc. All these people that are doing these jobs that never existed before this macro market rally, until they have to go back into the workforce, or a big percentage of them have to go back into the workforce and labor markets tighten again, to where employers have to say, or employers have the power again and can say, hey, no, we aren't just going to pay you whatever you want to ask for, because we have access to labor. The issue is right now employers can't find people to go to work, so they're having to pay an insane amount of money to get the small amount of people that are available to work to go to work. So in my opinion, employers, businesses, institutions, wealthy individuals, they're the ones who historically hold the vast majority of assets. If they are right now having to pay their laborers, their employees, their etc., higher rates per hour worked, or higher rates for their salaries, or higher rates to keep up with inflation, or higher rate just because they could go somewhere else if they wanted to, because there's all these job openings that nobody's filling, these employers having to pay higher rates, they all have investments too. In order to pay these higher rates, they have to sell their investments to pay for the new, more expensive labor that's up front. And they hold all of the investments. So as long as the labor markets are continuing to be so loose, where the power is in the hands of the employees, of the people looking for jobs, looking for raises, as long as they hold the power, in my opinion, markets aren't going to start trending upwards again. They're going to maintain this consolidation to potentially bearish trend, because institutions, hedge funds, employers need to shift this dynamic of power back into their favor, so that they don't have to pay an exorbitant amount of money for the labor that they're bringing in. So that's my opinion on why I think we are currently not trending too bullishly right now. And it has to do with labor markets. It has to do with jobs. And this, when Fried was asking about this earlier, I mentioned there are countless variables, confounding factors. There's so many different things that affect markets that this might just be one variable that's affecting markets. We're going to talk about other stuff like interest rates, quantitative easing, modern monetary theory, which rising interest rates over this past year, right? This is the percentage interest rate on the 10-year treasury, has been rising for this last year. We're going to talk about why rising interest rates does put a little bit of pressure on markets to go down, because money is more expensive. People who want to borrow money now have to pay more for that money. Anybody who's trading on margin is borrowing money to trade. So those margin traders now have to pay a higher rate to access that money. That's another thing that can cause bearish moves onto the market. Interest rates are, historically still at insane lows, even if the last year they've gone up. But the pain point is still there. My opinion is that it's more job focused this time than interest rate focused. I think the interest rates have not helped the issue of the market the macro market dynamics right now. But I also think that it's the jobs that's really, really being the cause of the pain in the market right now. And again, I'm also not trying to say this like it's a conspiracy, like the hedge funds or the institutions are all conspiring to dump markets together to try to get people back to work. It's just supply and demand. It's simple economics. If there are not a lot of people available to work, and the people who have to pay the people for work now have to raise the rates that they pay the people for work, now they have to get the money to pay that higher rate. Where do they get that money from? They sell their investments that they hold the vast majority of. It's supply and demand. It's economics. It's not some big conspiracy theory. But I do believe that until our labor markets tighten, until we get to a point where the jobs are less plentiful, where they're harder to get, where the employers at least have more of an equal share of the power, then I think that markets can start trending upwards again, because people are going to be investing their spare cash in markets instead of trying to invest their spare cash to capture the small amount of the labor pool that's available right now to capture, to produce the value that employers want to get produced. And I don't necessarily as well think that I want things to be to where jobs are hard to get, where the power is all in the hand of the employer. I like it when things are, around equal, where there's a good amount of jobs, but there's also the ability to negotiate good wage increases. I don't like when we get to the extrema, when jobs are wildly plentiful and you can't get anybody to work, or when jobs are nowhere and there's nothing available for work and nobody can afford anything. There's good and bad at both, and both extremes are something that we should try to avoid for the more moderate middle grounds. So Winfried, yeah, that's just my little background on current market dynamics and how I'm kind of expecting things to trend for the near future. So I guess shortly before we keep going, I said it on the voice chat we did earlier, but happy 12-year anniversary of the 12 years ago, the 10,000 Bitcoin being spent on 2 Papa John's pizzas. So about 12 years ago, Bitcoin had its first monetary transaction of value. People for the first time said, hey, this isn't vaporware, this has value, it can be spent as value. So that's something really cool to have happened about 12 years ago today. So just look into it if you don't know anything about it. Just a cool little, pop culture history of the Bitcoin progression. But next we're going to jump into something that Steak, actually, T-Bone, he and I were talking about a couple of weeks ago, I want to say, but modern monetary theory. So again, I don't dive deep onto all of these topics. I try to give you a simple overview, show you kind of a place where you can do more of your own research on it if you would like for yourself. So modern monetary theory, though, is basically a macro framework that a lot of new countries like the US, UK, Japan's been doing it for a long time. That's why their stock market and equities markets have been flat to down flat for a very, very long time. But it's places that spend, tax, and borrow in fiat currency. So like the dollar is our fiat currency that we control, but you're not really operationally constrained by your revenues because you have a finger on your own money printer. You don't need necessarily to bring in taxes to pay for military spending, education spending, social safety nets, any of these other things that we historically associate with it. And modern monetary theory challenges those conventional beliefs about the nature of money, and basically kind of goes into saying like, hey, these are leftover beliefs from the gold era. They're not accurate. Let's just put our finger on the printer and let it run hot. National debt isn't really a big thing to worry about. It's all fake anyways. Let's print our way out of it. And it's used in a lot of progressive legislation arguments for universal health care and other programs that governments typically argue they don't have the money to be able to spend. And so basically modern monetary theory is something that a lot of countries have tried who have come from less strong monetary backgrounds than the U.S. We're a little bit trying modern monetary theory now by running our money printer pretty hot, but we have a huge demand for our fiat currency, our largest export, which is currency. People still want to utilize the dollar worldwide. It's the global reserve currency. And so we're able to get away with a little bit of this. But other countries that have tried things like this, run through that death spiral of inflation, like Zimbabwe, where, they have $1 trillion bills now. Venezuela's running through a lot of it right now. There's so many countries that Turkey even has been having insane inflation. A lot of it because of modern monetary theories where they believe that you can just print your way out of your debts that you owe. Print the money, deflate the value of your currency, and then pay back the debts. I personally am not a huge fan of it, but it's here and it's happening. And if you pretend like it's not here and not happening, you're not really paying attention. So that brings me into like quantitative easing. And so I said I was going to talk a little bit about the Fed, right? How the Fed, why the Fed, what the Fed does. One of the ways that the U.S. government participates in modern monetary theory is through this thing called quantitative easing, right? So quantitative easing is the monetary policy that's used by central banks as a way to increase the money supply and spur that economic activity. And what they're doing when they're printing money, quote unquote, is they're not actually, everybody's seen the Jerome Powell on the money printer meme. That's not what's happening. That's a lot of stuff behind the scenes on spreadsheets, really. They go into a spreadsheet and they say, hey, we now have the assets to buy X amounts of treasury bonds or treasury bills. They buy those bonds, increasing the price of them, lowering the interest rate on them, allowing banks to borrow money at a lower interest rate, artificially inflating the perceived supply of money within the overall economy. And so something that can show you kind of how that works, here is a bond index fund, right? So when the Fed says we're going to buy bonds, they are physically buying this bond, purchasing this bond with money that did not exist. The price of the bond goes up as they're doing that. Price and yield work inversely. So let's look at a 5-year of this and a 5-year of this. I know they're slightly different instruments, but it was the best two I could find for showcasing the inverse nature of price to yield within the bond market. So the way that the Fed is influencing monetary theory, right? They're purchasing this bond, increasing the price of this bond. As they purchase it, the yield of that bond goes down. So let's look at from like 2018 to 2020, the price of this bond was going way up. So from 2018 to 2020, you can see that the yield on a bond, this is the 10-year note, so it's slightly different than what just this bond index fund is, but this is more of a broad overview of the bond market, and this is just looking at the 10-year. But the yield on that note goes down. And so what that means is that institutions, hedge funds, billionaires, banks who utilize this interest rate to borrow against have their entire financial picture changed, and that causes them to rebalance what they do from a purchasing equities perspective, purchasing bonds perspective, purchasing money markets perspective, purchasing in anything, private investments, public investments, infrastructure investments. Are they purchasing foreign currencies? Are they purchasing inflation hedges like gold or Bitcoin? This interest rate changes how all of these big players think about things. So when people talk about, the Fed's buying bonds, the Fed's dropping interest rates, making it cheap, when this interest rate is at lows, money is really cheap for rich people. So that means that they can buy as many assets as they want and pump the prices of those assets to infinity, basically. But when the Fed starts selling bonds, right, as they've been doing recently, quantitative tightening, not quantitative easing, not printing money, adding liquidity to the market. They're selling the bonds now. They're increasing that interest rate, making it to where money is now more expensive to banks. So before, banks could borrow money at maybe like a 0.5% interest rate. Now they're having to pay something around 2.7% interest on that money. On our small amounts of, $100, $1,000, $10,000, $20,000, 0.5% to 2%, it can make a big difference, but not an absurd amount of difference. But on $1 billion, on $10 billion, on an asset manager like BlackRock managing 8 some odd trillion dollars, I believe. Let me quote, I should look that up just to confirm. 0.5% to 2% makes a huge difference in nominal terms. Nominal meaning the actual dollar value of the gain or the loss. And so that's something else that I would encourage you all to start thinking about as well. Get out of the world of thinking of everything in percentage terms and think of things in nominal terms. Michael Saylor making his Bitcoin bet at around $20,000, the amount of Bitcoin he was able to purchase with his billions of dollars of debt have given him more nominal gains, then probably the vast majority of people, even people who got into Bitcoin when it was $100 a coin, $80 a coin, $1 a coin, or pennies a coin, could have potentially made, because he had access to so much money. He had access to so much nominal value that he doesn't need the 100,000% gain to get $1 billion. He could get 100% gain and make a nominal $1 billion. So get out of that thinking of percentage terms and start thinking about, how does this affect the market from a nominal perspective, even though from a percentage perspective, I don't wrap my head around, 0.5% to 2.5%. That's nothing, right? It's about 2% difference. But on a scale of $1 billion or $1 trillion, it does influence the market. So as these interest rates keep going up, money keeps getting more expensive. So the people who hold the assets, right, the people who have the jobs and pay the people for work, they now borrow money at a more expensive rate. They have to pay people more to go to work. And all of these other things are coming in to confluence at the same time. So that's a little bit of a look at the macro market, kind of modern monetary theory, money printer running hot, a little bit about how the Fed controls money, right? They make money cheaper or more expensive for banks by buying and selling bonds or other financial assets of the like. But yeah, encourage you to zoom out as well and notice that even on the long scale, there's really, we're going up over the past year, but we're still just hitting these low interest rates that we've been at, historical lows that we've spent almost the past decade or two, even at. So I don't know. It could go a lot higher if interest rates kept going all the way up and ended up at 15 some odd percent. I would expect markets to keep going down as debt kept being expensive and more expensive. People would have to sell their houses because debt would become more expensive. There'd be less new buyers of houses, because how could you borrow money at a 15% interest rate for 30 years to pay for a house? Everybody's used to getting this cheap debt, buying their houses for 3 to 7 to 5% or whatever. If debt got expensive, we wouldn't have all of that. So I don't know. I don't know where markets are going. I don't know if they print more money and markets continue price-wise going to infinity. But I do know that labor markets right now are skewed entirely in favor to the employee, not the employer. And so employers are having to spend a ton more money, sell all their assets to pay for the labor of production that they need to create value for their investors. So that's really all that I have today. Just a quick look at some of these levers that the Fed can use: modern monetary theory, quantitative easing, as well as just a quick background on the macro state of the market, kind of my opinion on it. But yeah, I appreciate everybody tuning in. A little bit shorter of an episode this week, just a 25, 30-ish minute one. I'm going to jump in the Telegram chat, though. If anybody has any questions, please feel free to drop them in there. I'll leave this open for another minute or two. But then after that, going to go ahead and hop off and give everybody back their Sunday. I'll ask if there's any questions real quick. But if there's not any questions, we will go ahead and hop off here very, very shortly. Looks like we're all good. I appreciate everybody stopping by again. Gonna jump off now. Thanks for joining us. Again, make sure that you like, subscribe, leave a comment, let us know what you want us to talk about next week. Thanks, guys.